In America, credit cards are more than just a method of payment. They're a cultural phenomenon. From late-night infomercials promoting the latest cashback offers, to young adults applying for their first cards the moment they turn 18, credit cards have become a staple of modern life. Their appeal lies in their convenience and accessibility. With just a few taps on a smartphone or a short online application, nearly anyone can get a credit card and start making purchases right away. Credit card companies sweeten the deal with flashy reward programs, offering cashback, travel perks, and exclusive discounts. At first glance, it seems like a win-win. But dig a little deeper, and a more complex story begins to unfold. For every consumer racking up points for free flights and luxury hotel stays, there's another drowning in debt, struggling to keep up with minimum payments as interest compounds. This duality is the essence of credit card culture in America, a system that can empower or ensnare, depending on how it's used. So, how exactly do credit cards make money? And why is it that some people benefit while others suffer? In this video, we'll unravel the surprising ways credit cards generate revenue, how they influence consumer behavior, and what you can do to navigate the credit system more wisely. Easy access, risky habits? One of the first things that stands out about credit cards in the US is how easy they are to obtain. Most young Americans can apply for a card as soon as they turn 18. Many issuers don't even require a solid credit history. Instead, they look at basic information like income, employment status, and identification. Some banks even offer student credit cards designed specifically for young adults with no prior financial background. The low barrier to entry might sound like a positive. It helps young people start building credit early, which is crucial for future financial goals like buying a car, renting an apartment, or getting a mortgage. But the flip side is dangerous. The ease of getting a card doesn't come with an equally easy understanding of how credit works. Many young users start spending impulsively, unaware of how interest charges work or how minimum payments barely make a dent in their balance. This accessibility, while beneficial in some cases, has also created a generation accustomed to instant gratification. The consequences of overspending don't feel real when you're just swiping a card instead of handing over cash. Unfortunately, these early mistakes can haunt users for years, as compounding interest turns manageable balances into unpayable debts. The psychology of rewards. Credit card companies are masters of behavioral economics. One of their most powerful tools? Rewards programs. Whether it's cashback, points for travel, or discounts on popular brands, these incentives are designed to encourage spending, and they work incredibly well. Let's take cashback programs as an example. Many cards offer 1% to 5% cashback, depending on where you spend. Groceries, gas, dining, travel, etc. On the surface, this seems like a smart financial strategy. After all, why not earn money back on purchases you'd make anyway? Savvy consumers learn to maximize these benefits by using the right card for the right purchase. If you spend $1,000, 0 cents a month, and your card gives you 2% cash back, that's $240, 0 cents a year in rewards. It adds up. But here's the trick. Studies show that people tend to spend more when they're earning rewards. It's a psychological loophole. You feel like you're saving money, so you end up spending more, often more than the value of the rewards you're earning. Even more interesting is that these rewards are non-taxable. Unlike income, which the IRS tracks, cashback and rewards points are considered rebates, so you don't owe taxes on them. This makes them even more appealing and gives consumers a false sense of free money. But that illusion can lead to dangerous spending habits if not managed carefully. High interest, the silent killer. While rewards may be the carrot, high interest rates are the stick. This is where credit card companies make a large chunk of their money. Most cards carry an annual percentage rate, APR, between 15% and 25%. If you don't pay your balance in full, interest begins to accumulate and fast. Let's say you have a $2,000 0 cents balance with a 20% APR and only make minimum payments each month. It could take years to pay off that debt, and you might end up paying double the original amount once interest is included. Credit card companies bank on this. They know that a significant portion of their users won't pay their full balance each month, and that's where the real profits are made. This system creates a dangerous loop. The more you owe, the more interest you pay. The more interest you pay, the harder it is to pay off the balance. It's a cycle that's particularly damaging for low-income households, which often rely on credit to cover basic expenses like groceries or rent. These consumers end up paying the highest price, while more affluent users enjoy the perks without the pain. Interchange fees, the hidden revenue stream. Credit card companies also make money every time you swipe your card. Literally. Each transaction involves an interchange fee, which is a percentage of the purchase price paid by the merchant to the credit card issuer. These fees typically range from 1% to 3%. For small businesses, this adds up quickly. To cover these costs, many merchants raise their prices across the board. In other words, even if you're paying with cash, you're likely paying higher prices because of interchange fees. It's a hidden cost passed on to all consumers, contributing to inflation in subtle ways. Meanwhile, credit card companies quietly rake in billions from this practice. It's worth noting that these fees also fund the flashy rewards programs we discussed earlier. That 2% cashback you love? Part of it comes from the fees merchants pay when you use your card. It's a sophisticated ecosystem that benefits the card issuers at nearly every stage of a transaction. Credit scores, a profitable algorithm. Another lesser-known way credit cards generate profit is through the credit scoring system. Your credit score determines everything from the interest rate you're offered to your chances of approval. Those with high scores get the best deals, while those with lower scores are charged more. This tiered pricing model means that the consumers who can least afford it end up paying the most. Banks and credit card companies love this structure. It allows them to price risk effectively while increasing profits from users who pose a higher risk of default. In many cases, the very system designed to reward responsible behavior ends up punishing those who've had financial struggles. American Express and the premium model. Some companies, like American Express, take a different route to profitability. Instead of relying primarily on interest, Amex makes a significant portion of its revenue from annual fees and premium cardholder services. Their strategy is to target affluent customers who are willing to pay for status, exclusivity, and high-tip customer service. Their cards come with perks like airport lounge access, concierge services, and large sign-up bonuses. While these benefits sound luxurious, and they are, they also serve as a powerful profit engine. Customers who can afford to pay the annual fee often spend more, and in return, Amex earns more through both spending and membership fees. This premium strategy is a perfect example where credit cards can be tailored to specific consumer demographics for maximum profitability. It's not just about offering credit, it's about understanding consumer behavior and crafting offers that maximize engagement and spending. The global credit card gap. When comparing America's credit card culture to other parts of the world, the differences are striking. In Europe, for example, debit cards are far more common than credit cards. European consumers tend to be more cautious about debt and often use credit cards only for emergencies or major purchases. Part of this is due to cultural attitudes, but regulations play a big role too. The European Union enforces strict rules on lending practices, interest rates, and interchange fees. This limits how much banks can profit from credit cards and reduces the number of flashy reward programs. As a result, European consumers are less likely to overspend and fall into debt. In contrast, America's relatively lax regulatory environment has fostered a credit-friendly culture that encourages spending and borrowing. Americans carry more credit cards on average than citizens in almost any other country. And the marketing of rewards and perks only fuels this trend. It's a system built on consumption, and one that continues to thrive. Calls for reform. As the credit card industry grows more powerful, calls for reform are getting louder. Advocates are pushing for limits on interest rates, stricter lending standards, and transparency in rewards programs. One of the most debated topics is the regulation of interchange fees. By capping these fees, some believe that merchants could lower their prices, benefiting all consumers. However, reform isn't easy. The credit card lobby is one of the most influential in Washington, and any changes to the system threaten a major source of bank revenue. Meanwhile, innovation in financial technology continues to evolve faster than regulation can keep up. In the meantime, financial literacy remains one of the best defenses for consumers. By understanding how credit cards work, the interest rates, fees, and rewards, you can make smarter decisions. The key is to treat credit cards as a financial tool, not free money. Final thoughts. Free credit cards are a double-edged sword. They offer convenience, rewards, and financial flexibility, but they also carry serious risks. The industry behind them is designed to profit at every turn, from the moment you swipe your card to the months you spend paying off your balance. For some, credit cards are a path to financial empowerment. For others, they lead to a mountain of debt. So next time you reach for your card, think about what's really happening behind the scenes. And ask yourself, are you using your credit card, or is it using you?